Hello, everyone. I'm Carrie Delgott, Wescott's Chief Operating Officer, and I'm here today with Mark McCarron, Wescott's Chief Investment Officer. Great to see you, Mark.
Good to see you, Carrie.
Mark, sell in May and go away is an old investment adage based on the historical underperformance of certain equities in the summer months. It's the belief that as warm weather sets in, the lack of market participants, presumably on vacation, will translate to lower volume and can make for a somewhat riskier or, at a minimum, lackluster market. With the selling pressure we felt in May, do we feel this statement is coming to reality?
Yeah, it's a great question. I think it's a great investment adage. And I would say very, short answer. While it may apply to some speculative areas of the market, we really remain fairly positive, fairly constructive on the market as the global recovery continues. So let's talk about 3 reasons why we should stay invested and not sell in May and go away. The first is that value and cyclical sectors of the market are, they tend to be a little bit more attractive during periods of rising inflation. And that's what's spooking the market. The inflation numbers came out recently and they're a little higher. So, investors are saying, okay, is this the end? In our view, value and cyclical companies represent a big part of the market, a big component of Wescott portfolios, and they look fairly attractive in this environment. The second thing I would say is developed in international and emerging markets outside the US, they should benefit from a continued opening because they're a little later in their recovery than the US is, and I think they have a lot more to run. And then the final thing I would say is that we have seen a bond sell-off. We'll talk about that shortly. That is because the yield curve is steepening, higher bond yields on a 10-year basis versus a 1-year basis. In general, that's a good thing. And we're seeing that support the banking stocks, but we're also really positioned for that within the bond portfolios to be emphasizing shorter maturity bonds rather than longer maturity bonds. So that's what we see.
You mentioned that developed international and emerging markets should benefit from continued reopening and are cheaper than the US markets. Can you expand a little bit more on that point?
Yeah, it's been a while since we talked about international markets. The last 10 years, the last decade has been a very good market, good environment for the US, but it's also been a good year so far for global stock markets. And we're seeing that in small companies and in more cyclical stocks, as I said, not just in the US, but globally. So on the right-hand side, we're just giving you an update here on what's going on in terms of the US market. Large cap is the blue line. Small cap is the orange line. You can see small companies outperforming large. But we're also seeing participation by developed, which is in the yellow, and emerging markets, which is in the dashed blue line. So these areas of the market, they also tend to have a little bit more emphasis on economically sensitive sectors, cyclical sectors. So when we're in a global recovery, we do see international markets participate more because of that. We've also talked about the bond market. The bond market is down, that's the gray line here, down modestly this year. And that is fairly typical when global recovery is accelerating. And we're seeing inflation, pick up a little bit. That's a negative for bonds. But just to highlight the fact that we remain very conservative in our bond positioning and less exposed to interest rate and inflation risk. And that's really what's driving the market, right? Inflation concerns have driven the market volatility. And we're seeing that most on the growth stock area, the technology stocks that have been the dominant ones for the last year, and some speculative areas of the market, and maybe including even cryptocurrencies.
Yes, cryptocurrencies, the other hot topic hitting the headlines in a really big way this month. Not only does mainstream finance follow, but a lot of social media, pop culture recognition with headlines that are highlighting significant volatility. What are your thoughts on the recent crypto crash?
Yeah, crypto crash. Well, it seems to happen more often in this market than in more traditional markets. Just to bring everyone up to speed, Bitcoin is the largest cryptocurrency. As we started the month, it was up around $64,000 per coin. It fell to 35,000 in 3 weeks. That's a 45% decline. And it's not just Bitcoin, but other cryptocurrencies. We talked about this a few weeks back: Ethereum, Cardano, and even Dogecoin, which has become sort of a meme cryptocurrency, very pop culture focused. It's also fallen dramatically. So I don't think the cryptocurrency crash is related necessarily to this idea of rising inflation, but I think they're more influenced by social media. Elon Musk's tweet recently about not accepting Bitcoin has really put the pressure on Bitcoin, particularly. Popular culture. Elon Musk was also on Saturday Night Live. A lot of talk about cryptocurrencies. And I think the most damning aspect of what's going on in the cryptocurrency market is it's a recognition and maybe a realization that generating Bitcoin through the way they do it generates a lot of energy, and it's very energy inefficient and effectively environmentally unfriendly. And that's an ESG factor that we're seeing sort of take a bigger role in Bitcoin in what it means. The final thing I would say is that, the more popular cryptocurrencies become, the more likely they will be regulated. We're seeing this in China and in the US, taking more of an aim at those who are trading it. So I think the final thing I would say on this is that equities derive their value from real fundamentals like earnings and dividends. Cryptocurrencies tend not to have, well, they don't have intrinsic value. Their value is whatever someone else will pay for them. And so maybe the old adage, sell in May and go away, can be applied to a very new market in terms of crypto, because it probably would have been a good idea to sell your Bitcoin at 64 and just go away.
All right, let's move away from the crypto world and into fundamentals and how we're positioned. Why don't you close us out today with a summary of our current outlook?
Well, we do take a fundamental view of the world and of the markets. Our portfolio strategy on the equity side is, we're remaining positioned in less expensive, but higher quality, and put it in quotes, less speculative areas of the market. And that's the area of the market that should benefit from continued economic recovery, both here and abroad. On the bond side, we've talked about this many times, but remain invested in shorter duration, which means less interest rate sensitivity in the bond portfolios. That tends to hold up better during periods of rising inflation, which we are seeing the start of. The final thing I would say is that equities and bonds are the core of client portfolios, but we've broadened out our alternative investment offering. And these include strategies to help hedge equity market risk. They also provide access in other strategies to private markets, which are less exposed to the day-to-day volatility. And then even others on the alternative side, other strategies that are designed to take advantage of some of the market events and the volatility that we're seeing to opportunistically add value and these can be used to complement the core portfolio. And so that's what we're seeing. We feel we're relatively well positioned for what we see coming up in the summer.
Thank you, Mark. Great update. We covered a diverse set of topics today, including the recent sell-off of some of the more speculative and expensive technology and consumer cyclical investments, with reinforcement that Wescott's diversified approach positions us very well going into the summer months. As always, please don't hesitate to reach out to Mark or your advisor with any questions, and thank you for your trust in Wescott.